Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of the ultimate guide to distressed debt investing. Investors often look for new ways to grow their wealth, and one such strategy is distressed debt investing. It's a high-stakes, high-reward arena that sets itself apart from traditional investment methods. In distressed debt investing, you're buying the bonds or debt of companies in financial trouble, often at a significant discount. The allure? These investments can offer substantial returns if the company recovers or is successfully restructured. However, it's not for the faint-hearted. The risks are considerable, requiring a deep understanding of financial and legal aspects. But for those willing to navigate the complexities, distressed debt investing can lead to extraordinary gains. Are you ready to explore the potential of this intriguing investment strategy? What is distressed debt investing? Distressed debt investing is a unique and compelling approach to growing wealth. By diving into the world of troubled companies and their financial woes, investors can uncover hidden opportunities that may lead to significant rewards. Let's break down what distressed debt really means and how the investment process works. Definition of distressed debt. Distressed debt refers to the bonds or loans of companies that are facing severe financial problems. These firms are often on the brink of bankruptcy or are already in it. Their debt sells at a steep discount because the market believes they might not be able to pay back their obligations. Conditions under which debt becomes distressed include default on payments, credit downgrades, and financial instability. Investors see potential in this chaos. They purchase distressed debt at low prices, hoping the company will recover. If it does, the value of the debt can skyrocket, leading to substantial profits. How distressed debt investing works. Investing in distressed debt is not as simple as buying low and selling high. It involves a deeper understanding of both the company's financial health and the broader market conditions. Identifying opportunities. First, investors look for companies in trouble. These can be identified through financial reports, credit ratings, or news about missed payments. Purchasing debt. Once a target is identified, investors buy the distressed debt, often through bonds or loans. Because the company is in trouble, these debts are usually purchased at a fraction of their face value. Managing and restructuring. After acquiring the debt, investors may take an active role in the company's restructuring process. This can include negotiating new terms for debt repayment or even taking an equity stake in the company. Example scenario: imagine a company, XYZ Corp, has fallen on hard times and its bonds are trading at 30 cents on the dollar. An investor buys $1,000 worth of these bonds for just $300. If XYZ Corp successfully restructures and recovers, the bonds may return to their full value, turning that $300 investment into $1,000. Exit strategy. Finally, investors decide when to sell their holdings. This could be once the company is back on stable ground or if a favorable restructuring deal is reached. The goal is to maximize returns while managing risks. Distressed debt investing can feel like walking a tightrope. It requires not just financial savvy, but also a keen insight into market trends and company specifics. The rewards can be substantial, but so are the risks. The key lies in thorough research and strategic planning. Types of distressed debt. Investing in distressed debt is like exploring a treasure map with different paths. Each path offers unique opportunities and challenges. Let's break down the primary types of distressed debt you might encounter. Corporate debt. Corporate debt comes from companies that are struggling financially. These companies could be on the brink of bankruptcy or already in it. One key aspect here is that corporate debt holders often have a say in the company's future during restructuring. How is it handled? Identifying troubled companies. Investors need to keep a close eye on financial reports, news updates, and credit ratings. Companies that miss payments or have declining credit scores are prime targets. Purchasing debt. When a company's debt sells at a deep discount, it's an open door for investors. They buy bonds or loans at a fraction of their face value, hoping the company will turn around. Restructuring. After purchasing the distressed debt, investors sometimes take an active role. They might renegotiate terms or push for changes to improve the company's financial health. For example, if a tech company has a rocky year and its bonds drop to 20 cents on the dollar, savvy investors buy in, aiming for a recovery that boosts those bonds back up. Sovereign debt. Sovereign debt comes from government entities. Countries sometimes struggle to meet financial obligations due to political turmoil, economic issues, or poor financial management. This type of distressed debt offers a different set of challenges, unique challenges. Political risk. Investing in sovereign debt means navigating political landscapes. Changes in government policy shifts or social unrest can impact repayment. Countries' financial health. The entire economy of a country is at play. Investors need to understand factors like GDP, debt levels, and international relations. Restructuring agreements. Governments may enter negotiations with creditors to restructure debt. These talks can be lengthy and complex, involving multiple stakeholders. Imagine a country facing a financial crisis where its bonds plunge to 50% of their original value. Investors might see a chance for significant returns if the country stabilizes and repays its debts. Real estate debt. Real estate debt deals with properties that are underwater financially. This category includes mortgages or loans where the property value is less than the owed amount. Real estate debt can offer tangible assets as security, making it an attractive sector. Opportunities in this sector. Foreclosure properties. Investors often look for properties nearing or in foreclosure. These can be bought at a discount and resold or leased for profit. Commercial real estate. Distressed debt in commercial properties, like office buildings or shopping centers, can be lucrative. Investors can purchase at low prices, renovate, and lease at higher rates. Improving properties. Sometimes distressed real estate simply needs a little TLC. Investors can buy, renovate, and either flip the property or hold it as a long-term investment. Consider a shopping mall struggling due to declining retail business. Its loans are in distress, but with a bit of investment and a shift to a mixed-use space, the property value could soar, bringing great returns to the investor. Exploring these types of distressed debt can open up a world of opportunities for those willing to dig deep and navigate the risks. Each category has its unique set of challenges, but with careful planning and research, the potential rewards can be immense. Benefits and risks of distressed debt investing. Investing in distressed debt can be a thrilling yet challenging venture. While it holds the promise of substantial rewards, the risks are just as significant. Let's walk through the potential for high returns and the various risks involved. Potential for high returns. Distressed debt investing can bring in high returns, especially if you play your cards right. The reason is simple. You're buying debt at a steep discount. If the company recovers, the value of that debt can skyrocket. Here's why this can be so profitable. Deep discounts. When companies are struggling, their debt often sells for pennies on the dollar. These low prices can mean high returns if the company gets back on its feet. Restructuring opportunities. Investors often get involved in the restructuring process. This active role can lead to better terms and greater control over outcomes. Senior debt. Distressed debt typically includes bonds or loans that have a priority claim. This means in case of liquidation, these investors get paid first. For example, if you buy distressed bonds of a company for 30 cents on the dollar and the company improves, those bonds might go back up to full value. That's a potential gain of over 200%. Risks and challenges. However, high rewards come with high risks. Investing in distressed debt is not for the faint-hearted and involves several key challenges. Credit risk. This is the risk that the company will not be able to pay its debt. Companies in distress are already facing financial troubles, making this risk quite high. Market risk. Market conditions can change rapidly. Economic downturns or sector-specific challenges can further impact the value of distressed debt. Operational challenges. Restructuring a company isn't easy. It involves complex negotiations and often requires legal proceedings. Key risks include default. The company could fail to recover, leading to a default where the debt becomes worthless. Liquidity. Distressed debt isn't always easy to sell. Limited buyers mean you might hold on to a losing investment longer than desired. Economic factors. External economic conditions can worsen the company's situation, making recovery even more difficult. Navigating these risks requires not only financial savvy, but also patience and a willingness to engage with the process. The potential for high returns is there, but it's crucial to have a firm plan and be aware of the significant challenges. Conclusion: distressed debt investing offers huge opportunities for investors who have the skills and courage to navigate high-risk scenarios. By buying the debt of companies in trouble, you can achieve substantial returns if those companies recover or restructure successfully. It's a complex world that demands thorough research, a savvy understanding of market conditions, and an appetite for risk. Remember, this field is not for everyone. The stakes are high, and so are the potential rewards. If you have the gumption to dig deep into financials, negotiate terms, and understand legal frameworks, distressed debt investing could be your path to extraordinary gains. Stay tuned for part 2 and continue to watch our videos to gain valuable insights into the world of finance.